Hi, I'm Jimmy. In this video, we're going to take a quick look at some of the key pieces of the US economy to see where things are and where they could be going in the future. We're going to quickly look at the unemployment situation, then we're going to look at GDP, and then we'll take a quick look at the stock market. Okay, so let's start with the employment situation. So just today, last week's jobless claims numbers came out, and they added another 5.25 million jobs lost. This brings the total jobless claims of the past 4 weeks to about 22 million people. And clearly we could see this is a massive jump in jobless claims. In fact, when we switch to a long-term chart, well, now we can see this chart goes back all the way to 1995. And this first little hump here, well, that little bump was the tech bubble. And then we saw a slightly larger bump. That was the Great Recession. And sure, relative to today's situation, those two examples sort of rolled into the recession and then rolled out of it. This one was a much more abrupt of a shutdown. So of course, things are going to be a bit more skewed. But either way, this is really abrupt. And when we switch over to unemployment, well, we can see that the unemployment rate just saw its numbers start to get worse. The most recent number came in at 4.4%, which, if we just heard that alone, that might not sound all too bad. But this is a monthly number, so it doesn't include a lot of the huge spike that we saw in jobless claims. So it's widely accepted that this is going to get a lot worse. In fact, we're already seeing that in the jobless numbers. Okay, now let's switch over to GDP, which is short for Gross Domestic Product. And in a recent video I did, I showed this chart here of GDP going back to the 1940s. This is real GDP, which means it's after inflation. And I pointed out this big dip of about 10%. That was a 10% loss in 1957, which, by the way, was tied to another epidemic, another virus called the H2N2 virus back in 1957. And we saw this big dip here in 2008. That was the fourth quarter of 2008. They saw a loss of a bit more than 8%. But here's why I bring this out again. I got a comment on that video asking about the breakdown of GDP. More specifically, how much of a role does the consumer play as compared to some previous years? How much of a role does the consumer play as part of GDP? So let's look at that. Okay, just so we're all on the same page, there's a few ways to calculate GDP, but one of the more popular ones is known as the expenditure method. Basically, we add up all the spending in the economy from all the major different pieces of the economy. So to get to GDP, first we add consumption, basically that's consumer spending, and then we add investments, that is business spending or business investments, and then we add government spending, and then we finally add net exports. And we might see an abbreviated version of this formula, and it would look something like, it would say something like GDP equals C plus I plus G plus X minus M. X is short for exports, M is short for imports. Okay, simple enough. Now, I was curious, how much does each group contribute to GDP, and how has that changed over time? So what I did is I went back to the fourth quarter of 1960. This is how much each portion of GDP contributed to the overall number. So consumer spending accounted for about 59%. Business investments was about 9%. Government spending was 32%. And net exports, it was a slight negative number, but we just rounded it to 0%. Now we can't forget that just a few years before that was the big 10% dip in GDP, at least partially due to the H2N2 virus. That happened in 1957. Okay. Now, if we fast forward a bit to the fourth quarter of 2000, this is 40 years later. Well, now consumer spending has picked up some ground. Now it used to be 59%. Now it becomes 66%. Business investments jumped from 9% to 18%. Government spending dropped from 32% to 20%. And net exports got a bit worse by dropping to negative 4%. That basically just means we export more than we import. Okay, moving right along. Jumping forward another 10 years to the fourth quarter of 2010. Well, now consumer spending rose from 66% to 68%. Business investments dropped from 18% to 15%. Government spending increased from 20% to 21%, and net exports stayed about the same. Now, this actually makes sense if we think about it. 2010 was the tail end of the Great Recession, and we know that the government had stepped up the amount that they were spending, so that partially explains the rise in government spending. We also know that businesses were struggling, so that explains the decrease in the business spending contribution to this. And we saw that consumers had just seen lower interest rates and they were urged to spend more as well, hence a slight increase there. Okay, now what if we jump to the most recent numbers, which is the fourth quarter of 2019, 9 years since our last numbers. Now, consumer spending has once again increased to 70% of GDP, up from 68% in 2010. And if we remember, the 1960 number was 59%. Business investments is 18% of GDP. This is higher than the 15% back in 2010, and it's about the same level as 2000. And it was double what it was in 1960, that at that time was 9%. Net exports went further negative from negative 4% to negative 5%. And we may notice that I kept this scale, the x-axis, the same through each of the years to help illustrate some of the growth of the economy. And I also want to point out that this scale is in billions. So 15,000 actually represents 15 trillion. Okay, now here's the real issue in the economy with the situation today. With consumers representing about 70% of GDP, what happens when the economy is forced to choke out consumer spending? Surely the government is trying to spur business spending with the whole stimulus package that they did, and they even trying to keep some consumer spending a little bit higher with possible $1,200 checks that some people are receiving. And I'm sure outside of that, the government's going to do what it can to pick up spending on perhaps infrastructure or things along those lines to try to up the government spending part of the equation. But this is certainly going to be bad in the first quarter of 2020 and the second quarter of 2020 as these numbers start to come in and we see how much the consumer actually dropped off. Okay, now this brings us to the stock market. And as we can see, the stock market has seen a pretty drastic pullback as investors began to realize how bad the coronavirus could really get. But in a somewhat confusing twist and an interesting move, the market actually had quite a decent jump coming off of the recent bottom. Now, we may have noticed on a day-to-day basis that the stock market seems to have fairly wild swings based on the flavor of the news that particular day, which can be really tough to stomach. And I think that we're going to have to get used to that for at least a little while longer. One of the primary things that the stock market does is try to predict where the overall economy is going to go, and ultimately where the companies that are on the stock market, where they're going to go. Well, when news comes out saying that things are getting better or worse, the market almost has no choice but to react to that. And I think this recovery, a lot of it is tied to the fact that there's some optimism that some of this could be ending soon, and the stock market begins to rally and react to that. Hopefully, that is true. But I think we need to be ready for if restrictions are lifted and there's a possible resurgence in the coronavirus, we might have to be ready for a lot of swings in the stock market. I personally think it will probably pull back again, but frankly, it's just a guess. Once GDP numbers actually come out, and don't forget, those are quarterly numbers, there's a lag to those, well, things could get a bit crazy, a bit wild. Now, I don't think it's smart for us to individually react to the wildness of the stock market. I think it makes sense for us to create our own investing rules based on our own personal investing goals and risk tolerance. And despite the craziness around us, I think I remain a big fan of long-term investing. And I think that if everybody else is going nuts and we're able to stay a bit more sane, I think that could be a very good thing for our portfolio. With that in mind, I actually did a video called The Art of Finding Great Long-Term Stocks. And if you're curious, that could be a good next video for you to watch. There's a link right here, and there's a link in the description below. And I want to thank you for sticking with me all the way to the end of the video. I hope you found this interesting. Thanks, and I'll see you in the next video.